Howdy, Jacob here. Today we're going to do an in-depth analysis on Wabash National Corporation. When we did the analysis, it looked to be pretty close to the buy price, and right now it's just 8% off the initial valuation that we completed. And so I ran through the quarterly reports and most recent 10K to analyze more of the business and to write down some notes to maybe give yourself some things to look at when you do your own analysis. Again, what I say will not be final. Please do your own analysis. This is just my judgment of the company and my projections based on this deeper review. This doesn't mean I'm buying at this price. It's just the way it is. Even if I was buying at this price, it shouldn't matter to you because you should have your own analysis and your own buy price. Because what I want in my portfolio is not necessarily going to be the same as what you want in yours. So just keep that in mind. And I'm going to start off by doing a review of the financials quick before going through some of the notes that I pulled from their most recent quarterly reports in 10K. So the growth has been pretty lackluster. We're seeing 1.9 billion in 2014 to 2.5 billion in 2023, where it did grow very heavily the 2 years post-COVID, but is probably averaging in the low to mid single digits here per year in revenue growth over the last 9 years. We are seeing gross margin increase substantially, but that could just be a 1 year thing, as even the 2 years before where revenue grew very substantially, it was actually right in line with the previous margins. And then same for the operating margin, where it looks to be almost double what it was 9 years ago, but it could just be the year we're in. And so, as with everything, you don't want to take 1 year of bad news to be end all be all, and you don't want to take 1 year of good news to be end all be all. You want to take an average of what you think the business is going to do. And to me, that's what I do. I use averages to come up with where I think the business will go based on where they've been in the past. But they have had a pretty good return on invested capital. Again, if you repurchase a lot of shares, that does inflate this figure, as your denominator is based on the balance sheet, and if you buy back shares, that can deflate that denominator, increasing your return on invested capital. So balance sheet shows 179 million cash on hand with zero short-term debt, just under 400 million long-term debt, and good production of free cash flow, with capital expenditures growing recently, meaning that they're reinvesting a little bit back in themselves, but then most of their money going out to share repurchases. That dividend currently pays out just 16 million in aggregate, which is less than 20% of their 5-year average free cash flow, probably closer to 10%. So if we go through some of the notes that I have before putting in my final analysis, so I do have that the backlog is a very important measure for them. And the backlog in 23 Q1 was about 3.1 billion. At the end of 2023, it was about 1.9 billion. And the most recent quarter was about 1.8 billion. So we're seeing a substantially lower backlog than the year prior. It is a bit more consistent with some of those pre-COVID levels. So it was more so that the 3.1 billion was kind of the outlier here. We wouldn't expect growth to be that substantial, which we did see 20 to 30% revenue growth 2 years in a row. So it was a substantial amount of backlog. This is more in line with what they've been doing pre-crazy of COVID, with everyone traveling and everything, moving, shipping products and such. Their CEO was fairly vague, so not good, bad, really just what it was. They point out earnings per share and backlog at times, and their forecast is really just quarterly. And so not much to brag home about. They didn't really bring up cash flow very much, and they weren't specific with their allocation of capital. And when I do say that, I actually had something funny I wanted to show. So I saw this. Hopefully you can still see it decently. So they had this in their 10K. So this is coming from their 23 Q4 10K, and this is just their capital allocation strategy. It just makes me laugh because it's literally just saying the 5 things that they can do essentially with their free cash flow. And they're just saying, I thought when I first read this, I was like, oh, their first objective is to maintain liquidity, and then to manage debt, and then to reinvest, and then dividends, and then share purchases. So your share purchases and dividend are the least important thing. But that's not what they're saying. They're basically just saying this is their strategy for capital allocation. They're not saying what's most important, and they're really just saying what you can do with excess capital, which I think is just so freaking funny. The only thing they don't bring up though is acquisitions. So unless that's your fund capital expenditures and research R&D strategy, yeah. So they don't really bring up acquisitions. So they just say maintain liquidity here. But really, the five things you can do with capital allocation is debt management, reinvest in yourself, acquisitions, which isn't there, pay a dividend, or repurchase shares. So I don't know. I just thought that was so funny. They just literally put in like, this is their capital allocation strategy, when in reality they're just pointing out all the things you can do with, through capital allocation. So not good, bad, ugly. I just gave me a chuckle. Hopefully it didn't derail you from the conversation here. But the next note I have is technological advancements by reducing the weight of their basic trailer by 300 pounds, and they have a refrigerator technology that has a 20% improvement in thermal performance. This is just to say that they're trying to differentiate themselves a little bit by not just having the same trailer as everyone, not just having the same cooler as everybody, but having some sort of technological advancement. Now, is that exactly what people are wanting? I mean, maybe. It looks like, if you make a longer trip, that 28% improvement in keeping everything cold could be very helpful, because obviously when you ship refrigerator items, you want it to be, cold longer. But if you have quick trips, it probably doesn't matter as much. And then to reduce the weight by 300 pounds, maybe that makes the semi more efficient and everything, less miles per gallon, or greater miles per gallon possibly. But just kind of cool to see that they're doing something technologically advanced, not just doing what everybody else is doing. But again, I think people are going to balance out, these advancements with how much extra does it cost, because cost is going to be a big driver of, how they're going to pay for it, or what they will pay for with their competitors. Their two main segments are their van platform and tank trailers, and their truck bodies and related products. Their five largest clients make up for about 32% of revenue, with the largest customer accounting for 12%. I wrote down some of their notable clients, which a lot of people should have heard about. So J.B. Hunt, Warner Enterprises, Old Dominion are going to be some of those moving trucker companies that and then your classic Kroger, Target, Walmart, Costco for some of those cold shipments, I presume. So they rely on a few number of suppliers for all of their raw goods. So to create the semis, and then to use all the parts in creating it, they rely on a few number of suppliers. So if there were to be any damage from one of them or one of those companies, it could hinder them. Again, just pointing that out, I think a lot of creators and shippers kind of use a few number of suppliers, but as long as it's not one or two, I think we're in a good spot. So that's just to call out. $396 million of debt, all due in 2028, so they still have a good amount of time. We're looking at about 4 years till due. And in the last 3 years, their capital allocation is dividends paying out roughly 21%, and then through share repurchases, they're paying out about 76%. So they're paying out quite a bit from their share repurchases. Their dividend is 21%, so very manageable. And so what I have here is, since they have been buying back shares very consistently, very heavily, and based on their current price of $1 billion, you're looking at about 400 million, 412 million, 40 million plus 12, so about 50 million to repurchase 4% of shares. And based on their 5-year average free cash flow, I think that's reasonable. Otherwise, I just minimize their PE based on the fact that I minimize their growth a little bit because they've grown so much recently, and their PE due to the fact that I'm trying to base their price to earnings off of their enterprise value, not necessarily the market cap. And so this does dampen the price down quite a bit to about 44% drop before you get the 15% return that we're looking for. And I think that I'm definitely more comfortable with the PE here. I think 15 would have been a little bit frothy, but due to the fact that maybe their growth is going to dampen, and then also, again, like I said, I'm going to be basing their PE and price free cash flow off of more so the enterprise value rather than their market cap. And they're going to have to start focusing on paying down that debt, which could diminish their ability to, or their allocation on dividends and share purchases to be paying down that debt. I do hope you enjoy the video and learn something. Have a great rest of your day. Thank you.